stop. Right now. You think you're being smart because you've been saving money? You're wrong. Every single night while you sleep, inflation is quietly eating away at your savings, silently, without making a sound, without you even feeling it. And that so-called safe money? It's guaranteeing you a retirement, a poor one. I'm James Harrington. I've built multiple companies, I manage a multi-billion-dollar portfolio, and I sit across from entrepreneurs every single week. And today I'm going to tell you what nobody else will. Your savings account is your single greatest financial enemy. Let's talk about the first catastrophic mistake, hoarding cash for fake liquidity. People tell me all the time, James, I keep cash because I need liquidity. That's not a strategy. That's an excuse. It's the language of fear dressed up as wisdom. Yes, you absolutely need some cash on hand. But 6 months of expenses, 12 months, 2 years, that is financial insanity. That is you voluntarily sacrificing tens of thousands, maybe hundreds of thousands of dollars in future wealth for a worst-case scenario that has an incredibly low probability of happening. Here's what I actually do. I use a liquidity ladder. A small amount sits in true immediate cash for genuine emergencies, the kind that can't be put on a credit card. The next tier sits in short-term treasury bills or a money market fund inside a brokerage account, currently yielding over 5%. My money is never idle. Even my liquidity is working for me around the clock. The action step here is simple and brutal. Calculate your bare minimum monthly expenses. Multiply that number by 3. That is your maximum cash cushion. Everything above that number is not an asset. It is a drag on your financial engine. Move it. Now let's talk about the second and perhaps most dangerous mistake, believing that cash is safe. This is the biggest lie you have ever been sold, and I want to destroy it with mathematics because math doesn't care about your feelings. Say you have $100,000 sitting in a high-yield savings account earning 1%. Inflation is running at a conservative 3%. At the end of the year, your account shows $101,000. But because of inflation, you now need $103,000 to buy the exact same things you could afford a year ago. In real terms, you have lost $2,000. You are poorer, you have guaranteed yourself a negative real return, and you didn't even know it was happening. That is not safety. That is slow-motion financial suicide. I define safety as a growing stream of income and the long-term preservation of purchasing power. A dollar bill is not a store of value. It is a unit of account that is being devalued every single day. The only genuine safety is in owning assets that generate a return above the rate of inflation. That is the entire game. I am obsessed with dividend-paying stocks and ETFs precisely because that dividend is real, tangible, and predictable. The market can be volatile, but a quality company with a long history of paying and growing its dividend is not going to zero. Your capital in a bank account? It already is going to zero, slowly, quietly, and guaranteed. The third mistake is one I hear constantly, and it makes me want to flip a table. James, the market is at an all-time high. James, a crash is coming. James, I'm waiting for the perfect entry point. Let me tell you something I have learned over 4 decades in finance. Time in the market beats timing the market. Period. Full stop. End of story. This obsession with waiting for the perfect moment is just fear wearing a suit, and it is the single greatest reason ordinary people leave life-changing wealth sitting on the table. Here is what the data shows, and data does not lie. If you had invested $10,000 in the S&P 500 and missed only the 10 best days over the past 30 years, your total return would have been cut in half. Half. And you cannot predict when those days will come. They happen during recoveries, often when fear is at its absolute peak, exactly when people sitting in cash are too scared to move. After the 2008 financial crisis, when every talking head on television was predicting a second Great Depression, I didn't try to call the bottom. I started systematically deploying capital into high-quality dividend-paying companies, Johnson & Johnson, Coca-Cola, and broad-based ETFs like SPY. I wasn't buying at the perfect moment. I was buying at value, collecting dividends and reinvesting every single one. That discipline, not brilliance, not timing, is what builds fortunes. If investing your full amount at once scares you, then dollar cost average. Take your $10,000 and commit $2,000 on the same date every single month for 5 months. Automate it. Remove the emotion entirely, but get off the sidelines and get into the fight. The fourth mistake is ignoring the most powerful wealth-building machine ever created, the dividend. My philosophy is simple. I want to get paid while I sleep. When you own dividend-paying assets, a company is sharing its actual profits with you as an owner. It's not speculation, it's participation. That cash hits my brokerage account every quarter, and I make one decision. Do I take it as income, or do I reinvest it to buy more shares and accelerate the compounding engine? Let's put your $10,000 side by side. Park it in a savings account at 0.5%, and in a year, you've made $50. Take that same $10,000, put it in a dividend growth ETF yielding a conservative 3%, and you've made $300 in year 1. But here's where it gets extraordinary. Quality companies grow their dividends. Assume 5% annual dividend growth. In 10 years, that $300 annual payment has grown to nearly $500. You are now earning a 5% yield on your original investment, and the principal has likely appreciated substantially on top of that. Meanwhile, your cash in the bank is still earning 0.5%, if you're lucky. I build my portfolio around funds like the Vanguard Dividend Appreciation ETF, known as VIG, and the iShares Select Dividend ETF, known as DVY. These are baskets of mature, profitable, well-managed companies with decades of growing dividends. They provide income, stability, and the kind of psychological grounding that lets you hold through volatility without panic selling. All right, you're convinced. You're done with these mistakes. You've got your $10,000 and you want to know exactly what to do with it. Let me give you the precise framework I use for my own capital. You can implement this in a single afternoon in any brokerage account. First, we establish defense. Take $1,000, 10%, and place it in short-term U.S. Treasury bills or a money market fund, like the Vanguard Federal Money Market Fund, VMFXX. This is currently yielding over 5%. It is safe, it is accessible, and it is actually earning a return. This replaces your useless savings account entirely. Second, we build the core engine. Take $6,000, 60%, and put it to work in high-quality, low-cost dividend growth ETFs. $4,000 of that goes into the Vanguard Dividend Appreciation ETF, VIG, which holds blue-chip companies like Microsoft, Johnson & Johnson, and Visa, companies that grow their dividends year after year. The remaining $2,000 goes international into a fund like the iShares International Select Dividend ETF, IDV, which exposes you to stable, cash-rich companies across Europe and developed Asia. Your combined yield here will likely be in the 2.5% to 3% range, but the growth of those dividends over time is where the real wealth is built. Third, we add targeted growth. Take $2,000, 20%, and allocate it to sectors that pay you to own the future. Put $1,000 into the Global ex-US Infrastructure Development ETF, PAVE. This is a direct bet on the rebuilding of roads, bridges, and electrical grids, a decades-long trend with government backing. Put the other $1,000 into the Illyrian MLP ETF, AMLP, which gives you exposure to pipeline and midstream energy companies. These are essentially toll road businesses that generate massive, predictable cash flows and currently yield between 6 and 8%. This portion meaningfully boosts your overall portfolio income. Finally, take your last $1,000, 10%, and make a calculated, research-backed bet on 1 or 2 individual dividend-paying companies you genuinely believe in. Maybe it's Apple. Maybe it's Cisco. Maybe it's a financial company you've spent time studying. This is your ownership stake in a specific story. It keeps you engaged and intellectually sharp. But it is capped at 10%, which means even if you're completely wrong, the damage to your overall portfolio is contained. This portfolio is structured, diversified, and disciplined. It generates cash flow from nearly every position. It has a global footprint. It has a defensive cash component that actually earns something meaningful. Your $10,000 is no longer sitting in a bank account rotting. It is a fully functioning, income-generating, compounding wealth machine, a scaled-down version of the exact strategy I use for my own capital. Let me give you the summary because repetition builds discipline. There are 5 wealth-destroying mistakes you must stop making immediately. 1. Hoarding cash for liquidity you don't actually need. Build a ladder, not a swimming pool of dead money. 2. Believing cash is safe. It is not. It is a guaranteed loser against inflation. Real safety is purchasing power and cash flow, not a nominal number that looks stable while it quietly shrinks. 3. Trying to time the market. You will fail. Everyone fails. The data is clear and brutal on this point. Get in, stay in, and let time do the heavy lifting. 4. Ignoring the dividend engine. Your goal is to own assets that pay you simply for owning them. Stop speculating and start building a money machine. 5. Having no plan. I just handed you one. A disciplined, allocated, globally diversified framework that puts every dollar to work. Wealth is not built by accident. It is built by intention. It is built by making your capital work harder than you ever could. The biggest risk you face is not a market correction or a recession. The biggest risk is inertia. It is letting fear and indecision keep your money in a vehicle that is mathematically designed to lose value. I have shown you the mistakes. I have shown you the framework. The rest is entirely up to you. Stop being your own worst financial enemy. Start acting like the disciplined, rational capital allocator you need to be to build the future you actually want. If this message landed, hit that like button and subscribe because next week I am breaking down exactly how I analyze a dividend stock, the 5 specific numbers I look at before I commit a single dollar. You will not want to miss it. And go to the comments right now and tell me, which of these 5 mistakes have you been making? I read every single one. This is James Harrington. Now go put your money to work.